Fears were rising that China and the U.S. could see a full-blown conflict in the wake of rising tensions between the two countries. Here to discuss geopolitical risks with us is Professor Steve Hanke of Johns Hopkins University. Professor Hanke, welcome back to the show. It's a pleasure to have you.
Good to be with you, David.
Headlines were made late last week as China closed the U.S. consulate in Chengdu in response to the U.S. closing of a Chinese consulate in Houston. Now, Professor, have you ever seen this kind of diplomatic hostility in recent times between any two great powers?
Well, not in recent, but it's happened before. And the main point, it's real and it's ramping up. You could see it almost by reading the newspapers carefully. All the hawks and neoconservatives came out of the woodwork and started really banging on China. This has been in the works for a while, but it's going on steroids now. So we saw it, by the way, in various forms even before the consulate was shut down in Houston. There was a news report, Bloomberg broke the story, that the U.S. was considering cutting off the access to dollars in the Hong Kong Currency Board as well as Hong Kong banks. Fortunately, that didn't happen. I had advised strongly that this would be a disaster for the U.S. dollar because Hong Kong, since 1983, has had a currency board system. The Hong Kong dollar exists, but it's backed 100% with U.S. dollar reserves. It trades at a fixed exchange rate to the U.S. dollar, 7.75 Hong Kong to the U.S. So the Hong Kong dollar is a clone of the U.S. dollar. It's the same as the U.S. dollar. And if you would cut the Hong Kong Currency Board off from access to U.S. dollars, it would be a real blow to property rights in what? The U.S. dollar. It obviously would upset the apple cart in Hong Kong and have negative ripple effects in mainland China. But the main thing is we would have been shooting ourselves in the foot by absolutely slamming the dollar. And this gets to a critical point. One, they did not do this. They were considering it, but the U.S. did not do that. The other thing is that, more broadly speaking, sanctions have been something that's been used broadly since 9/11 by the George W. Bush, by the Obama administration, and certainly by Trump. Every time you turn around, he's putting someone on sanctions, financial sanctions. Now, this kind of undermines the dollar's credibility and the dollar stance. And I think that's one reason the dollar has been getting a little bit weaker. But more importantly, for Kitco people, that's another reason that gold is making new highs. And that's all related to these sanctions things or talk about undermining the currency board, the dollar-based currency board in Hong Kong. That's when gold really started taking off. When those noises started coming. So sanctions are coming into play in general, these general hostilities. The Fed has been goosing everything. Inflation will come back to some degree, no doubt. All those things are big positives for gold. And also with regard to gold, it's obviously superior to bonds at the current yields you're getting on bonds. And it's become competitive with equities. So we've noticed in the last 6 months that retail buyers of gold and ETFs, just ETFs, have outpaced central bank buying gold. That's the first time that's ever happened. Central banks are the big boys. But now we're seeing retail investors coming in. And it's basically because gold has become competitive with equities and certainly superior to bonds. So where it's going, we don't know. In the meantime, as I recently told my daughter this morning, ride the bull.
Yeah. So we're going to touch on gold in just a minute, but going back to the geopolitical tensions here, what we're seeing in regards to what you mentioned, the dropping of the Hong Kong currency board and hostilities with, or diplomatic hostilities with the closing of the consulates, what is the underlying driving force behind sort of this fallout between the U.S. and China, and how can it progress from here? There's talk of a new Cold War. There's talk of a potential real conflict. What are your thoughts?
Well, the kind of idea behind it, it's been around for a while. Number one, you've got a communist regime, so that puts it right away. It's not a capitalist private property kind of system. It's still politically a communist system. So that's one thing. And then you've got key advisors in the White House, which are important. Peter Navarro, for one, has always taken the position, and the president has been somewhat more on board lately, that China's basically ripping off the rest of the world, stealing their property, intellectual property, trying to basically confiscate lands in the South China Sea that aren't Chinese by any stretch of the imagination. And so you get all these things piled up, and pretty soon a lot of people are starting to buy into it. And I think the U.S. position is become pretty dogmatic. That's the U.S. position. And Chairman Xi, the other side of the coin, he's turned back the Deng kind of liberalization of China that started in 1979. I mean, the greatest growth in the world history has been China. The greatest free market person in the world wasn't Adam Smith. It's Deng. And Deng was the one who opened China up. I mean, the biggest privatizations. We've never seen anything like movement towards a freer and more liberal market and more private enterprise, the expansion of private enterprise in China. Now, Xi is basically turned back the clock on that and put a stop to it. So the conflict starts because Xi is on one side. He wants to be more hardline communist. And you have a group in the United States in particular, advisors like Peter Navarro in the White House and neoconservatives who take the opposite side, and they're starting to conflict now. I mean, where the rubber meets the road, they're starting to butt heads with each other. I mean, they have two completely opposing points of view, and I think it will get worse before it gets better.
Now, Professor, throughout the last 100 years or so, we've seen the most relative peace in terms of not seeing conflicts with major powers. We've seen the most peace when there was one major superpower dominating the world, as China, as some would say, is challenging U.S. hegemony. Would you say that you can expect more geopolitical tensions popping up amongst the proxy states, and as a result, investors being worried about the economy and driving volatility up? Could you see that happen?
Well, in general, I think right now with negative real interest rates in the United States, we're seeing this as far as equities are going, they're going up now. There could be corrections, very significant corrections. You could get the market down 20 or 25% in a week if there was some bad news event, some near miss in the South China Sea between an American aircraft carrier and a Chinese destroyer or something like that. But generally, it's a pretty positive picture as far as investors go, and we've already talked about gold. Gold is very positive, going up, and so are U.S. equities. So
right.
So I wouldn't get too excited about the coming conflict and competition. It is coming. It will be real. We will have bouts of technical adjustments due to bad news, very, very significant adjustments, but the trend is, as far as I can see, up, not down, and it will continue as long as real interest rates remain negative.
Yeah.
Because just look at it. I mean, even if you have multiples where they're at, the yields are still much higher than negative real interest rates. So, and until we hit the point where inflation starts getting up to around 3.5 or 4%, and the Fed finally has to say, "Gee, we're gonna have to start tightening the screws to get inflation under control," I think things will stay pretty much on the bright side. There's some little negative spots here, there, and elsewhere, but in general, positive.
Now, Professor Hanke, when you say things could get bad, how bad could it get? Because is it really in the self-interest of either party, China or the U.S., to escalate tensions?
Well, no, I don't think so. But you know, I'm not the chairman of the Communist Party in Beijing, and I think the Chairman Xi seems to be very, very dogmatic and stuck in his ways, and inclined to basically turn the clock back, stop the Z kind of liberalizations and so forth. That's point number one. And then on the other side, you've got quite a bit of pushback coming from the White House and various associated quarters. So it's that part of it is not good. The reality is that things are not going to get better between the U.S. and China anytime soon. I don't see any clever diplomats working the street that would calm that down. So we can expect some bad news events leading to significant market corrections, even though we're in an up market on equities and obviously the gold market, and everybody's jumping into silver. We haven't even mentioned silver, but
I mean, silver. You're right. You're absolutely right. Silver has also been on a tear recently, and I wonder if this has anything to do with economic growth or lack thereof, especially in the U.S. I'm going to show the viewers this chart here. It's showing unemployment comparisons between the U.S. and its peers. Unemployment in the U.S. is just over 10% now, which is significantly higher than other G7 areas like the Eurozone, Hong Kong, and the UK. Why do you think this is? Why is the US lagging its peers in recovering employment?
Well, I think the basic reason is the way they have handled the largesse and compensation going out of the various fiscal authorities into supporting labor. And in Europe, these people aren't furloughed; they're paid to basically stay on the payroll. So they're furloughed. They're not unemployed. They don't count as unemployed. In the U.S., that's not the mechanism. The mechanism is one where, they are being paid, but they're also unemployed. They're not furloughed in many cases. So that's the big difference between Europe and the United States. As far as Singapore and Hong Kong, these places have stayed in the game. They're very free market, flexible economies, and they've continued to do pretty well, even though they've taken big hits in GDP, or at least Singapore has. The unemployment picture remains pretty good.
Professor Hanke, last recession, when it ended in 2009, the U.S. Pulled ahead of other developed countries in terms of economic growth quite quickly. What were the factors behind that outperformance, back in 2009? And are those forces still in play today? Can the U.S. be expected to pull ahead this time?
Well, when you say pull ahead, it was really in terms of relative to Europe. And I mean, the big thing is the U.S. is a much more free market, flexible, private sector dynamic kind of economy than Europe. Europe is pretty much stuck in a rut of being highly intervened by governments. Governments are much larger portion of the economy than the private sector in most of the European countries. So they're really not very dynamic. They're pretty stagnant. And that it's structural problems. It is the structure of the U.S. economy is flexible, much more private sector, faster to react, and so forth than Europe. Now, the one, of course, 2008, 2009, China didn't miss a beat. I mean, China just kept going, and the reason for that was they weren't burdened by a lot of overregulation of their banking sector, and the money supply kept growing at a good clip in China. They ignored the Basel III regulations for capital asset ratios and so forth. And the U.S. had Dodd-Frank, a lot of bank regulations. They had Basel III, which increased the capital asset ratios. Europe more or less saw the same thing. So you had credit in the United States, bank money produced by banks, which was 90% of all the money in the United States, is produced by commercial banks. That actually dropped in the United States. If we hadn't had quantitative easing in the United States to mitigate that fall in the banking sector, emission of bank money, we would have been in a Great Depression. The way it was, the money supply broadly measured by Divisia M4, put out by the Center for Financial Stability in New York, it slowed way down, even in the United States. It was only growing, 4% or something like that. We would have come out of the thing much more rapidly if banks hadn't been so overregulated. That's the U.S. story. Now, it was even worse. It was even worse in Europe.
Finally, you've written about hyperinflation in Lebanon. I found this story fascinating because you would expect hyperinflation to be the last thing to happen during a time when aggregate demand has been killed. Tell us about this story.
Well, the main story is that the money supply, did what it always does on hyperinflations. It's growing. The currency collapsed. It's down over 80% since January. The main thing is people lost confidence in the pegged exchange rate that had existed, with the Lebanese pound being set at 1,500 Lebanese pound per U.S. dollar for many years. And there were fun and games were being played by the central bank. It was financing directly and indirectly huge fiscal deficits in Lebanon. Finally, people started saying, this can't continue. These high interest rates that we're getting paid in Lebanon can't continue. And so they started dumping their Lebanese pounds. And as I say, this year it's down over 80%. And when you get a currency that crashes, bingo, you start getting a lot of inflation. And the inflation went up. Last Wednesday, they entered the hyperinflation zone, meaning there were 30 consecutive days in which I was measuring inflation daily. And the monthly rate, it was exceeding 50% per month every one of 30 consecutive days until last Wednesday. Bingo, 62nd country in the world to enter hyperinflation. They're pretty rare.
Yeah.
In the MENA countries, that's the only country that's ever had a hyperinflation. So they're in the middle of the soup in Lebanon. They have a huge currency crisis. I think the only way to get out of it is to put in a currency board like Hong Kong's, where they'd fix the exchange rate for the Lebanese pound. They'd back the Lebanese pound 100% with U.S. dollars and let it trade with free convertibility, no capital controls or anything like that. If they did that, it would fix it within 24 hours.
And last question, we're seeing monetary stimulus in the U.S. On an unprecedented scale. Can we see hyperinflation here as well?
Well, no. We've never had hyperinflation in the United States. I mean, yeah, it's always a possibility if they would continue with an expansion of the money supply at the rate they're expanding it now for a year or so. Yeah, we could see very very high inflations. I don't anticipate that, but to forecast what you think the Fed's going to do next is hard to do. I think what will happen is that inflation will, it's more or less baked in the cake, start going up, and it'll go up and to an uncomfortable level for the Fed, and one the Fed doesn't anticipate right now. Let's say 4%. 4% would be pretty uncomfortable for the Fed, and the Fed is not forecasting that. But let's say this big injection gooses the thing and it starts going up to 4. Then I would anticipate the Fed would start tightening. And if that happens, of course, the stock market is going to be quite vulnerable. And there'll be a lot of companies, by the way, with very weak balance sheets that are vulnerable too. So then's when the game starts. The blue skies, the clear skies, the positive message I gave you about equities when we originally started, that's the end of that game.
Fantastic, Professor. You've made some excellent points. I really appreciate your time today. Thank you for being here.
Good to be with you, David. Thanks for inviting me.
And thank you for watching Kitco News. We'll have much more for you. Stay tuned.